Good afternoon, everyone. Welcome to the last paper for the conference. The final paper is called Cross-Venue Liquidity Provision, High Frequency Trading and Ghost Liquidity. The paper is written by Hans de Gresse, Rudy Devine, Carole Gresse, and Richard Payne. And we're fortunate today to have Carole Gresse joining us to do the presentation. Carole is a professor at Université Paris-Dauphine. So I'll hand over to Carole to get started.
Thank you, Carole. Can you see my slides?
We can, yes.
Okay. Well, thanks again, Carole, for chairing this conference. And many thanks to the organizers for having us on this program. For what I've seen so far, it's really a great program. This paper is a joint work with Hans de Gresse, Rudy Devine, and Richard Payne. And Hans is with us online, actually. And also, it's a work that uses special data built by ESMA, the European regulator. So the usual disclaimer applies here. The paper reflects our own views and not necessarily those of ESMA. The main topic of the paper is the concept of ghost or phantom liquidity. What do we mean by ghost liquidity? We mean liquidity which is over-provided, over-provision of liquidity. So it's liquidity which is supplied to markets, but not necessarily intended to be executed in full. And the liquidity providers who will post this ghost liquidity have an intention to cancel very fast if they need to. That's a phenomenon that's been identified in a single market setting by previous papers. And in that case, we can see that fast traders temporarily over-provide depth at several limits of the order book, just to get to the front of the limit order queue. And then they cancel as soon as they are executed on one of those price limits. What we are interested in here is ghost liquidity in fragmented markets. And that's a scenario in which ghost liquidity may be more frequently used. For example, if we imagine a case in which we have two trading venues, and we have a fast liquidity provider who is willing to submit limit orders. The first choice could be to submit limit orders only on venue A. But then if the liquidity demand arrives first on venue B, the trader will miss out some trading opportunities. So if that liquidity provider is willing to reduce execution delays and to reduce execution costs, another possibility is to duplicate his limit order on venue B. And then as soon as he's executed on one of those two venues, he can cancel limit orders on the other one. This is a strategy that can be useful to avoid time priority on venue A, for example, and also to increase execution probability. However, this cannot be done without cost. So the possible cost is that this trader could be executed on both venues at the same time, just because there could be simultaneous trading or because he's facing liquidity traders using smart order routers. So what is the key implications of those strategies if they exist? One key implication is that those limit orders which are not intended to be executed in full and which are probably cancelled very quickly will not be accessible to all traders and especially the slow traders. So it could create instability in the liquidity of fragmented markets, and it could result in an overestimation of the consolidated depth across markets, especially for the depth available to slow liquidity traders. And in that sense, it would challenge the liquidity benefits of fragmentation that were found in the previous literature, like in the paper of Foucault and Mengveld, O'Hara and Ye, de Gresse et al. So what is the motivation of the paper and what are the research questions that we address here? One first thing is that limit order duplication has been observed already in previous work. In particular, in two reports by ESMA, they have observed that 20% of all orders are duplicated across European markets. And about 24% of those orders are cancelled, either to be completely cancelled or to be repriced outside the current prices. Also, we have academic papers showing that in fragmented markets, when you observe trades in one venue, immediately after that, you can see cancellations on other venues. So this has been shown in a paper by Van Kerbel published in the Review of Financial Studies, and also by a study by Chen et al. And in Van Kerbel's paper, there is a model which demonstrates that, in fact, those cancellations are efficient because they are just, quote, updating in reaction to new information conveyed by trades on a given venue. So all of the venues are just updating their quotes. What we look at is different. Our empirical strategy is to measure the amount of cancellation which is not related to, quote, updating, but just corresponding to ghost liquidity, in the sense that liquidity providers are duplicating just to increase their execution probability or reduce execution costs. And to do so, we need to measure liquidity provided to markets at the trader level, and we need to follow the same trader across venues. And in that empirical strategy, of course, member IDs are key. So the goals of the paper are, first, to estimate the magnitude of ghost liquidity in fragmented markets and the impact it can have on competition benefits. Then to identify the economic determinants of that ghost liquidity. And last, to investigate the impact it may have on trading costs. To do so, we use a data set provided by ESMA. It's a proprietary data set which was collected from several national authorities and exchanges for the month of May 2013. We have order book and trade information for 91 stocks of 9 European countries. And we have trade information and order book information for the primary exchange and the 3 largest alternative exchanges that were active at that moment, on that period, namely BATS, Chi-X, and Turquoise. What is very important in the data is that we have anonymous IDs for 388 members, and those IDs allow us to track those members across platforms. So this is key for the identification of ghost liquidity in our study. The trade data are timestamped at the millisecond, and order book information is recorded every 10 milliseconds. And this is the way we measure ghost liquidity. So our strategy is to start by looking at a trade. Anytime a trade is taking place, we look at whether the liquidity provider in that trade is duplicating orders on another venue. So we have the trade venue where we observe the triggering trade, and we have the quote venue on which we observe the depth which is provided by the same liquidity provider. And so we observe that depth on the quote venue or the ghost liquidity venue as it was just before the trade. Then we observe the depth provided by that member just after the trade. We compute the difference, and of course, we take into account the executions that are taking place on this other venue also, to measure the quantity of liquidity that the member removed from another venue after being executed on the trade venue. Then we aggregate this ghost liquidity at the day level, and we scale it by the total pre-trade liquidity which is provided by the same member for the same stock. We also have another measure in which we scale that ghost liquidity by the size of the trade that triggered the measure of ghost liquidity. So we have 2 ways of scaling that ghost liquidity. Now, how do we measure depth? And which prices do we take to measure depth? What we do is that we have a spread measure which is stock specific. So we observe the distribution of the third limit consolidated spread for each stock and we take the 90th percentile of that spread, of that distribution, sorry. And this is the spread inside which we measure depth. So the advantage of that is that we get something which is close enough to the mid-quote, but large enough also to account for all the trading activity, which is significant. And also what is important is that it is stock specific. If there are any clarification questions at this time, I can take them.
We have no questions yet, so please keep going.
Perfect. So what do we get in terms of ghost liquidity magnitude? So when we measure ghost liquidity in percentage of the pre-trade liquidity provided to all markets, we find that it represents around 4% of the total liquidity. One thing that I didn't say is that when we look at the change in the liquidity provided by the member we observe, we take the smallest time window that we can, which is 10 milliseconds. And we also look at what it would be if we increase that window to 20 milliseconds, 50 milliseconds, 100 milliseconds. And it doesn't change really. What we find is that this average is stable and remains around 4%, just a little bit above 4%. Now, when we look at the level of ghost liquidity by pair of platforms, what we see is that the level of ghost liquidity is higher on alternative platforms, and especially HIX and VATs. We get the same result when we measure ghost liquidity as a percentage of trade size. So all stocks combined, all venue combined, what we find is that when a member is executed on 100 shares on one venue, on average, if that member has duplicated orders on another venue, he will cancel 20% of the size of the first trade, that is 20 shares. And once again, this is stable, whatever the time window that we take, and it tends to be greater on alternative venues, and especially VATs and FIX. Now, what we do with the data is that we classify members according to 4 criteria. The first criteria is trading aggressiveness. So we distinguish members who are liquidity takers most of the time, and members who are liquidity suppliers most of the time. We also look at the trading scope in terms of the number of venues they use. So we consider that a member is a global trader as soon as he trades more than 10% of his trading volume outside of his main venue. So anyone who is trading more than 90% of their trading volume on a single venue is a local trader. And of course, GL makes sense for global traders, essentially. Then we look at another criteria, which is trading speed. So we have a flag in the ESMA data identifying fast traders according to the lifetime of orders. And among those fast traders, we distinguish algo traders and pure HFTs. And the way we identify pure HFTs is just by looking at their primary business. So any firm which is publicly declared as a firm whose primary business is high frequency trading, and any firm who is a member of the European Principal Traders Association will be considered as an HFT in our sample, and it's 21 firms. And the last criterion that we use to classify members is trading capacity. So we have a flag in the data to identify when a member is trading as an agent or when is trading as a principal. Very expectedly, people who duplicate orders the most are liquidity suppliers, global traders, fast traders, and members trading as a principal. And among people who duplicate orders, of course, global traders have a higher level of ghost liquidity, and members trading as principal also have more ghost liquidity. And people who post the highest level of ghost liquidity are HFTs. Also, we look at whether ghost liquidity is followed by quote updating by computing a refill rate in the next 10 millisecond time window. And our refill rates on average are very close to 0. So we consider that what we measure is actually ghost liquidity. Any question at this stage, Carole?
No, you can keep going. Thanks, Carole.
Perfect, thank you. So now the main goal of the paper is to understand what are the determinants of this ghost liquidity. And the main hypothesis that we have in mind a priori is that ghost liquidity is a trading strategy used by members who are implementing market-making strategies, and they do that to increase their expected profits by reducing execution costs. So this type of strategy only makes sense if the order flow is actually fragmented, if there is a high probability that liquidity trader will be on different venues. So the first hypothesis that we test is that GL should increase with fragmentation. Another thing is that a liquidity provider will have a greater incentive to post ghost liquidity if there is no other way to compete in price. And this could be the case if the tick size is large and if the tick size is binding. So we look at whether GL increases with tick size. Then we have three other hypotheses regarding market making activity. So our main hypothesis is that ghost liquidity is used in market making strategies. So we should observe that liquidity suppliers post more ghost liquidity. We expect members trading as principal post more ghost liquidity. And also, we think that ghost liquidity should be related to members' inventories. So we consider a priori that members having very large inventories and inventories in excess of the optimal level should have a greater incentive to post ghost liquidity because they have a pressure to avoid non-execution risk. So we posit the hypothesis that GL should be increasing with inventory. And last, ghost liquidity is an efficient strategy only if you have an effective trading speed advantage upon other traders. So we make the hypothesis that fast traders will post more ghost liquidity, but that their trading speed advantage will be less effective if they are facing a great amount of smart order routers. So we expect GL to decrease with smart order routers activity, and we use a proxy for that. And last, we think that trading speed advantage are more easily exploitable on alternative venues, so we make the hypothesis that GL should be greater there. We control for several things, in particular liquidity determinants. We control for the fact that GL could be a systemic phenomenon, but the most important is that we control for a potential informational story, which could be that there is cancellation in the market just because members are incorporating information conveyed by trades on other venues. So to do that, we control for order imbalance. Because if we have an information-based story, we should see GL increasing with order imbalance. What do we get in terms of findings? So we run regressions in which the dependent variable is ghost liquidity by member, by stock, by pair of venues, and for a 15-minute period in the trading session. And we ran Tobit regressions because our dependent variable is truncated to 0. First thing, in that regression, so we have order imbalance in the same period and in the previous period, and we completely rule out the information-based story because we never find that GL is increasing with order imbalance. We find that GL is increasing with fragmentation. We find that it is part of market-making strategies because liquidity suppliers and members trading as principal post more ghost liquidity, even after controlling for liquidity determinants. Also, we confirm that trading speed advantage is a very important determinant. So fast traders exhibit higher level of ghost liquidity than other members. And when the triggering trade is taking place on an alternative venues, we observe more ghost liquidity than when the triggering trades happens on the primary exchange. And last, we find a significant relationship with smart order routers activity, but it is a non-linear relation. So what we find is that GL actually decrease with smart order routers, but only when their activity is over a certain level. So when the activity is very large, that's the only situation in which we observe that GL is actually decreasing. We also find a significant relation between ghost liquidity and the inventory of the member who's posting that ghost liquidity. But the surprise is that it's not in the expected direction. So yes, it's part of a market making strategy, but not necessarily when inventories are large. It's used when inventories are small. So in fact, instead of being used to rebalance large inventories, it's rather used to build up inventories. Then we go further by running the regressions by categories of traders, and in particular, we focus on fast traders and liquidity providers, and we distinguish among fast traders, we distinguish HFTs and algo traders. And what we find is that HFTs post even more ghost liquidity than algo traders. And when we look at the ghost liquidity of fast traders, what we observe is that the highest level of ghost liquidity is observed with high frequency trader when they duplicate orders between alternative venues and when the primary exchange is not involved. We confirm that there is a significant relationship with the members' inventory, and it's in a direction that was not first expected. So they post more ghost liquidity when inventories are small. And we confirm the relation with source in the same way as for all global traders. Now, we also check something else to be sure that what we consider ghost liquidity is actually ghost. We check whether it could be just a strategy of relocating liquidity. So, for example, you have a member providing liquidity on some venues, and that member observes that trades are occurring on another venue. So they think that the activity is going there, and they think that in the end they should reshuffle their liquidity. So to check that we don't have this phenomenon, we calculate refill rates on the trade venue in the next 10 milliseconds. And we find that those refill rates are close to zero. We do the same for all venues consolidated. So we look at GL as measured on as consolidated across venues, and we look at the refill rate in the consolidated order book over the next 10 millisecond period. And there again, we do not find any positive refill rate. So we reject those alternative explanations, and we consider that what we measured is actually ghost liquidity. Now, an important question is to understand whether this ghost liquidity has an impact on the trading costs of other traders. So to do that, what we do is we look at the relation between the ghost liquidity observed in the market and the size of effective spreads for liquidity traders. And we distinguish the cases of slow liquidity traders and fast liquidity traders. And what we find is that slow liquidity traders pay larger effective spreads on the primary exchange only when GL increases. And this makes sense because most of the time, slow liquidity traders are local traders on the primary exchange. And this, those larger effective spreads, in fact, the economic impact of this relation is greater when that GL is posted by HFT. We also find that algo traders face larger effective spreads when GL is increasing, and this is for all venues. And for HFTs, what we find is that they are absolutely not impacted by GL. So their trading costs do not increase with GL. And this is very intuitive in the end. So to summarize our findings, we find that GL ghost liquidity is an economically significant phenomenon in markets because when we see a liquidity provider being executed on 100 shares on one venue, on average, that liquidity provider will cancel 19 or 20 shares on another venue in another order book. However, at market level, it's not sizable enough to create great instability in the liquidity of the market. And it's not large enough to challenge the liquidity benefits from fragmentation. It remains around 4% of the consolidated liquidity, and it's a bit higher on alternative venues where it can reach a level of 7% of the total liquidity provided there. In terms of determinants, if we look at the cross-section of stocks, we see that ghost liquidity is greater for larger and less volatile stocks, and it increases with fragmentation. The level of ghost liquidity is greater for liquidity providers, principal traders, and HFTs. We observe the highest level of ghost liquidity on alternative venues, and especially for high-frequency traders duplicating orders between alternative venues. We find a significant relation between ghost liquidity and the presence of smart order routers. It's a concave relation so that ghost liquidity decreases only when smart order routers activity is very large. And the interesting finding that we didn't expect is that ghost liquidity is used to build up inventories and not to reduce extreme inventories. And last, there is an impact on trading costs for some traders, especially slow liquidity traders on the primary exchange, for whom there is an adverse effect, and there is no impact for the trading cost of HFT. And this is it. Thank you for your attention. And we're looking forward to hearing the comments of Ingrid.
Terrific. Thank you very much, Carole. So the discussant and the final discussant for the conference is Ingrid Werner. Ingrid is a professor at the Ohio State University. She's well known for her work in microstructure, particularly in short selling and dark liquidity. So is a perfect discussant for this paper. So over to you, Ingrid. I think you may still be on mute.
Yeah, that's why I was finding a place where I could unmute myself. Thank you so much, Carole and Carole. It's a double Carole day today. And thank you so much to Plato for organizing or sponsoring this conference. It's been great, even though some of the sessions are in the middle of the night, my time. So I'm going to talk about ghost liquidity. And as of course, Carole has gone through the paper very clearly, I'm just going to go a bit more big picture. And what I want to start with is kind of just a visualization of what I think most people have in mind. And this is an illustration I took from a publication that I will cite more clearly in the future here. But it's a visual where a co-located HFT posts 4 limit sell orders at Euro 625 for 25,000 shares in each of the venues that we're talking about here, BATS, Chi-X, Turquoise, but also on the primary exchange, in this case, Euronext. And when a institution, for example, sees these 4 orders and sends in 4 child orders to hit those 4 venues with their purchase, the first one reaches Chi-X, and because the high frequency trader is co-located, it manages to quickly cancel the orders at BATS, Turquoise, and Euronext before the institution's orders arrive. So this is kind of the classic that we've heard complaints about from Michael Lewis's Flash Boys and why we have all this discussion about speed bumps. So just to visualize, that's kind of, I think, what most people have in mind when we talk about ghost liquidity. Was it really there, or was it not? Was it intended to be executed, or was it just shopping for potential business? And Carole and her co-authors are looking into, does it matter for the stability of the market? They speculate about effective spreads and so forth. So that's kind of the big picture. Now, the data that they have, they got from ESMA, who earlier on conducted several studies of this and created a sample stratified of 100 stocks in 12 European trading venues. They do already provide a fair amount of descriptive statistics on ghost liquidity on European markets, and Carole already flagged that in her presentation. I don't want to go into details about what they found because they're very similar to what Carole and her co-authors find. But the one thing I just wanted to show from their study is, they look at liquidity fading after a trade. And if you look at the graph here, what you see is the green line is the actual purchase, but the fade of liquidity is significantly larger as measured by the orange line, and it decays over time, but most of it is in the very first 10 milliseconds, which is similar to what Carole mentioned. Now, what the conclusions are that ESMA draws from their look at the data is, they find that multi-venue trading increases liquidity in equity markets in spite of the fact that we have a ghost liquidity. And they agree with Carole and company that based on what they observe, we do see some overestimation of liquidity supply if we were to look at just aggregating across the 4 venues I just showed you and thought that there were 100,000 shares available if they're going to be canceled. So where does this study come in? Well, they use the same data set, they screen it a bit, and they find some of the descriptive findings they just confirmed from the ESMA study, but they certainly do a lot more. They provide much more refined measures of ghost liquidity. They drill down to separate high frequency traders from algo traders by doing detective works to kind of classify them. They do a much more detailed analysis of a country breakdown and platform analysis than at least I saw in the ESMA work. And perhaps more importantly, they focus on the economic determinants of ghost liquidity and on the effect of ghost liquidity on trading costs. So let's take a look at HFT strategies to kind of a little better understand what ghost liquidity is. So on the left here, we have a stock and it's trading. And when you see a line here, that's the beginning of a quote, and that limit order is available until it's canceled when the line ends, right? So sell orders on top, buy orders at the bottom. You see a lot of orders, some orders live long, other orders are very, very short. On the right, they have actually taken out one HFT. And I did this just to kind of get a sense for what we're talking about here. And so this is one player in one stock and their order activity. When you see this, you can't help but ask yourself, what the heck is going on over here? Clearly, there's like a lot of activity way above the market prices by this market participant, the HFT. Potentially spoofing, maybe they want to show that markets are going down, they're scaring the markets. I have no idea. But that's the first thing I noticed when I looked at the graph. The second thing is that if you look across, you see that the market maker, I try to blow it up here, at any point in time has orders all the way up in the order book, right? So there's like a whole stash of orders at different prices by the same market participants. And finally, you see that the market participant here, this particular HFT, tends to have both sell orders and buy orders at the same time in the same stock, in the same venue. So this is one venue. So clearly, it's not easy to measure, the link between, what is there and what is not, and what is ghost and what is not. So it becomes even more complicated when you try to look at 4 platforms. Here again, we have Euronext Amsterdam, Kayaks, BATS, Europe, and Turquoise. And what you see if you start here, this is the primary venue. The HFT tends to be competitive in the primary market. By that I mean that the orders tend to be quoted close or posted close to the actual trade prices. But the HFT populates away prices both in the primary market in all the three competing venues. So there's a bunch of activity way away from the action in all of the different venues. The other thing that you see here is when the HFT posts orders in the competing venues, they are extremely fleeting, meaning they don't tend to be competitive for very long. So if they're competitive, they're kind of canceled quickly. Right? And you know, when you look at all these four panels, you say, this is hard. Measuring ghost liquidity is hard. And the authors do a great job trying to kind of tackle that problem. And Carole already showed this graph. So the key here is they measure the idea of ghost liquidity, cancellations being triggered by a trade. And then they look at the changes in other venues of the quoting activity. So change in liquidity supply at other venues. I want to highlight it's the same side of the market. It's between limit order book snapshots, and it's within a specific range away from the mid quote. What I mean is stock specific. And then they take out the net volume traded by the market participant. So clearly, this is a great way of trying to kind of standardize across stocks, but it is a much broader measure than duplicated orders. Like in my example, the order was all at the same price. Now we take up a couple of prices that we can choose as being eligible for orders to be included in the ghost liquidity. So you could have an order at 25.60 and an order at 25.61 and an order at 25.62, and you execute at 25.61, but it's canceling the orders that are at higher price levels, right? So that is important to keep in mind because this is a bit broader measure of what's considered as ghost than the clean duplication of the order. Then following up on this idea of the strategies, I looked at the study that I quoted that I took the picture from it's by the Dutch regulator. They argue that, HFTs, when they looked at similar data, market makers, which are usually liquidity supplying HFTs, are risk averse. So, if they get hit on one of their orders, they're going to reassess their risk and they're going to unload the positions as quickly as possible or cancel orders. Now, I have to say that this, of course, is a little bit contradicted by Carole's and company's results that inventory has a negative sign in their regressions for the determinants. But they also point to this idea that they may have to adjust their pricing after seeing an order, meaning they may update the value of the stock that they assess. So based on this, looking at the data, the Dutch regulator says this is not a problem. Ghost liquidity is really a logical consequence of market-making strategies in a fragmented marketplace. And the challenge here that we are all grappling with is to try to figure out are these duplicate orders of ghost liquidity ill-intended or nefarious, or is this just a natural feature of liquidity provision strategies? The authors do look at, this is more detailed, I'm going to skip over it, but they look at refill rates to see if the orders are replenished within that window, which would allow it to move by a cent in European terms or by a penny in the US or not. And they do a good job of that. So let me just skip that in the interest of time. But what I think would be interesting to look at is, other papers have come to a different conclusion in a way, in the sense that they say that really, this is by Blocher et al. I just took it out of their abstract. They look at NASDAQ data for S&P 500 stocks, and they look at high and low cancel clusters. So they're not as detailed a data as the data that Carole and company has access to, in the sense that they can't link the trader between, platforms and so forth, but they look at bursts of clustering of cancellations and low cancellations. And if I read it correctly, their conclusion is that the cancel clusters really are a result of jockeying for a Q position and reacting to information, as opposed to having anything to do necessarily with the trade itself. So it would be good to compare a bit more to the other papers. This is not the only one, I just focused on that. So do these kinds of canceling activities occur without trades in your data? You look at trades specifically, but you could say, well, do we see this canceling activity if someone else executed a trade at a price that's close to the orders by the particular market participant that you're looking at? And do trades occur without cancel clusters, right? And so this is kind of trying to gauge if this is important or not. Now, the economic determinants, they all make sense. And it is kind of intriguing that it's perhaps creating inventory as opposed to trying to reduce inventory that guides ghost liquidity. But I thought that was, it all made sense, and I'm not going to speak more about it. It was a good job. The only thing I would say there, it would be helpful to have a bit more descriptive statistics of all the many variables that you actually create. And I applaud you for doing that, but it was a little hard to kind of understand the size of and magnitude of those. But when it comes to economic significance, I come back to this picture I started with, because depending on the measure and member category that you use, you find about 3 to 6% of pre-trade liquidity and about 5 to 18% of trade size is ghost. But the picture that I showed you suggests that it's 4 times as many, or that is for every trade you cancel 3 orders, so 300%. So really it's much more rare that they cancel than what we have in mind based on the Michael Lewis's story. So that makes me think, should we really worry about this? It seems relatively small. So then I do applaud you for saying, okay, let's take a look at effective spreads. And that's a great analysis. And I prepared Carole for this by saying I was having a little hard time gauging the economic significance of the effect on spreads from that study of the, and what I try to do, and this is just representing the coefficient estimates that were of importance, the effect that she finds on effective spreads are for the slow traders, right? But you find that this, and this is significant only because the effective spreads are, yeah, forget about this. I was going to say, this is the size of these coefficients. I would, instead of drilling down on this and explaining what I did, I tried to, relative to effective spreads, put them in percentage terms. And it seems like it's less than 1% for sure, even the effect you measure. So let me end by just by saying, tell us a bit more about the magnitude of the effects. So perhaps more importantly, when it comes to the end, after having gone through this exercise, it was a little unclear to me, what is the policy recommendation that you have for regulators or for market participants? How should they change what they do? Because you say it's an economically significant phenomenon that deserves attention, but then you say it's not big enough to cause any trouble, if I read you correctly. So maybe you guys have to make up your mind what it is. And it is an important question because fragmentation is a big concern. This is the US distribution of trading activity for equities. And, you know, we are only there, we're talking about 13 exchanges and growing, but you also have the dark venues and you have the internalized trade. So clearly fragmentation is important. Other people have argued it's good. And if I look at what's happening, there's demand for fragmentation and people are willing to supply new venues. Just this month, there are 3 new platforms that are going to go live, if I believe everything works out, in this month alone. Memex, MIAX, Pearl, and long-term stock exchange, LTCE. And they're backed by market participants, market makers, routing firms, broker-dealers. And so clearly they want more venues. And over time, we've seen this kind of ebb and flow in fragmentation, consolidation, fragmentation again on the ownership side, but in many cases, they continue operating the platforms they acquire. So clearly this is a huge issue. So I applaud you guys for working on this to try to better understand if it causes issues with ghost liquidity. So the paper documents prevalence and driving forces and consequences of ghost liquidity, and it is a feature of fragmented markets. It's important. But as I said, is it large? Is it bad? If so, who is hurt by it? What would markets look without ghost liquidity? Is it related to speed bumps? And how does it look like in other markets? There's a discussion about FX as well, where ghost liquidity has been argued to be a problem. And finally, what are the policy recommendations? But I do recommend everyone read the paper. It's got tons of really, really interesting details. So thank you.
Excellent. Thank you very much, Ingrid. Plenty of food for thought there. We have a few questions from the audience, so I'll take those questions first before we give Carole an opportunity to respond to some of those comments. Perhaps, Ingrid, we can just get you to unshare your slides. So the first question comes from Brian Taylor from BTA Consulting, which perhaps is a tricky question, but we'll see how we go. He says, Carole, he notes you've also got expertise in the fixed income markets. So he says, what do you expect to be the analogous result for the scale of fixed income ghost liquidity? And in the more liquid fixed income markets, which is highly fragmented, multiple venues, but also has also algo and HFT trading.
Wow, that's a great question. From what I know, I think that the structure of the trades on fixed income markets, and we're talking about bond markets, is completely different from the stock markets that we study in this paper. In the sense that trades are much larger. The market is very decentralized, but between, I would say, between dealers, not between venues. So I guess it's completely different also because the transparency is different. So you have the prices that you can observe on the platform, on the screens, and there are also the prices that you can negotiate on the phone, probably with your dealer. So I would not expect the same phenomenon in bond markets. Just because the frequency of trading is not as high. But I mean, I have not used data from the bond markets in the same way. So it's just speculation from what I know.
Terrific. Thanks, Carole. I'm sure you'd be very happy to have someone provide you with the equivalent data for the bond market. So we also have a question from PK Jain from Memphis. He says, perhaps the claim of ruling out alternative information story is too strong. It's hard to know the true intentions and desired quantity, the inventory of the trader, which can change not just based on order flow and execution, but also on the informational news feeds, which evolves on a continuous basis. So can you control for the use of machine learning in the process to process news by HFTs?
Okay. So what is true is that the way we rule out the information-based story is relatively narrow, because what we consider is information which is conveyed by trades and by imbalance between between sells and buys, and that's it. We do not consider any other type of information. So there could be other type of information. Information may arrive in markets in another way. This is true, but as we were also looking at the relation with inventory, this seems to be the most relevant way of looking at it. Also, and this is linked to Ingrid's discussion, our GL measure does not take into account cancellations which are completely based on incorporating information and not following trade or execution. So this is also why probably we don't see a link, because we have excluded from our measure other types of cancellations which may be linked to information, and to information which is of another form or just trade conveyed information.
Right. We have a few questions from Davids and Heath. The first one is, there are many other factors changing that could plausibly explain associations between ghost liquidity and other market dynamics. Which way or ways do you think the causality runs? So the age-old causal question.
So in the paper, we tried to address the causal questions by using, when we regress on fragmentation, we regress on the fragmentation in the previous period. Also, when we look at the impact of smart order routers activity, we take into account the current value on the same 15-minute period, but also on the past period. So for a few factors, we did try to address the causality issue. And this is why also we had started with looking at GL at a daily level, and then we could only look at correlations. And in this version of the paper, we decided to look at the relation at the 15-minute level, 15 minutes period level. So I think for the most important factors that we look at, we do look at a causality. Maybe not perfectly, but at least in some ways.
Yep, great. Davidson's next question ties in very carefully with what the issues Ingrid has raised. And he's asking whether you can give a sense of the magnitudes involved. So, you know, what's the economic magnitude? Are these really relevant? They're obviously statistically significant. How economically important are they?
Yes, it looks like there is a bit of contradictions in what we write, but the idea is that what we mean is that at the market level, everything consolidated, there's not much to worry about. But there are cross-sectional variations according to market conditions. And so our conclusion means that if you are a liquidity trader, according to the kind of stock that you trade, according to the kind of venue on which you are, according to market conditions at a given time, ghost liquidity may increase at a level that can be harmful for you, and especially if you are a slow trader. That's the idea.
Okay, great. And his last question, which is another tricky one, what are the welfare effects for the various market participants? Do you have anything to say about that?
Well, I think Hans de Gresse is online. Maybe he can answer that in the chat. Well, welfare effects, we don't really look at that. I think the welfare effect, if we wanted to say something about that, we should look at another question that we don't address in the paper, which is when you have market members posting ghost liquidity, overall, is it harming the market, or is it providing liquidity that is useful? So is there a dynamic effect that when you observe ghost liquidity, in fact, it attracts liquidity traders and it attracts new participants in the market? So that's the kind of dynamics that could be interesting to look at, but we haven't done it. So, and this would probably answer that question. So because if, for example, let's say you're a regulator and you have the power to say ghost liquidity is forbidden. Maybe if members who are providing liquidity in the market are forbidden that, you will see that those people will participate less in the market and that it will overall harm the liquidity, even if you see that when there is ghost liquidity for a certain kind of traders, effective spreads are increasing. So I think it's a great question, and it would need more analysis to answer that question, and probably to look at the dynamics between liquidity and ghost liquidity. But then looking at causality effect could be tricky, I think.
Terrific. That's all the questions we have from the audience. So we've got a couple of minutes left if you wanted to raise or respond to any of Ingrid's other suggestions.
Well, first, thank you for your comments. I think they're very relevant, and it's interesting to see another view on the topic with based on some observations and some literature, etc. One point I would like to say, I think I addressed it by answering one of the questions. It's that when you talk about the work by Blotter et al. And those cancellation clusters, which are in fact responding to information arriving in the market, it's true that compared to what they do, our measure is not capturing that. And it could be very interesting to compare what we would get in terms of cancellations level by looking at that. So probably when we have at the market level a percentage of liquidity which is no more than 4%, if we included all those cancellations, probably we get something which is much higher. But then if it's incorporating information, it's not really good. It's just efficient cancellation. So that's the issue, and this is why we don't incorporate those in our measure, because we want to focus on what is not information based. Also, you pointed out that we are not giving statistics about some factors that we use. Probably what you have in mind is the level of smart order routers activity, variables like that. Yeah, so this was a choice because there are already many tables in the paper, but maybe we should say a few words in the text about that. So I don't have the figures in mind, but what I can say is that when you look at the average level, the level of SOR is usually lower than the level you would need for GL to decrease because of the concave relation. So this I can say for sure. Otherwise, I don't have the actual numbers in mind.
Let me just pipe in real quick, if I may. It's about trying to understand the economic effect of the coefficients you estimate. Because if I don't know the mean or the distribution of the right-hand side variables, it's very difficult for me to know how big the economic impact is as a fraction of the left-hand side variable. So that was why I was asking. So maybe you can do that by actually speaking to the economic effects of the variables in the text.
Mm-hmm. Yes, thank you for pointing this out. I think we need to say more about the economic magnitude of the effect, and the same for effective spreads. I agree. We'll have to work a bit on that. Thank you.
Excellent. Thank you very much. We're spot on time. So let me conclude by thanking Carole for a wonderful presentation and Ingrid for a terrific discussion. And a great way to wrap up the end of the conference. And I'll also thank again all of the presenters and discussants throughout the conference who have done a really great job helping us better understand market structure.
Thank you.